I was recently asked the question, should I get a whole life insurance policy for my child where I, the parent, pay into it for 10 or 15 years, and then after that, I give it to my child and they can continue to make payments? Or is it better to get a policy where I just pay into it for 10 or 15 years and then stop altogether after that? The answer is it heavily depends on which one you like more. Because while option one sounds better, as the child can continue to make payments, when you look at the cash value, option two can often be a lot more attractive. So we're going to compare both. What we're going to look at is a policy for someone's 5-year-old son, and we're going to look at two products with the exact same company. What we're going to look at is one, what is called a life pay. So this will complement option one, meaning they say for their 5-year-old, I want to pay in $10,000 per year for 15 years. And after that 15-year period, I want to give it to my now 20-year-old son. So my son is now 20, and say, son, here's this policy. Look how it's performing. You can continue to put money into it. And they won't be obligated to $10,000 per year. A lot of times we get the question, how do you design a policy for a child? If you want your child to have the option to continue to fund it, what I usually like to do is set that minimum premium, which would be the commitment if they keep on paying, as low as possible. Because when you were 20, could you comfortably put in $10,000 per year to a product without being stressed out? How about 5,000? How about 3,000? Probably not. So we don't want it to feel burdensome. So if someone's paying $10K per year, be set up where the minimum is $1,000 per year. So if they go with option one and give it to the child can easily pay $1K per year, but can still scale up to $10,000 per year. So they have a lot of flexibility. So option one is they give it to the child, where the child can keep on paying, versus option two, it's the same thing, but then they just stop. And you can go with a life pay. Like you can get a life pay option, which is a product that's typically payable to 90 years old or 100 years old, sometimes longer than that, and stop early. But the thing to be aware of, there are also what are called 10 and 15 pay products. These are limited pay policies that are designed by life insurance companies to emphasize cash accumulation. For example, if you were to look at MassMutual's whole life insurance products, they have their Whole Life 100, which emphasizes death benefit, and then they have their 10 pay, 15 pay. They even have an 8 pay product, which emphasize cash accumulation first. Meaning if you just bought a basic life insurance policy from MassMutual and measured the cash value growth with a 10 pay versus a Whole Life 100, the 10 pay would produce a much more attractive cash value, short-term and long-term, specifically when you look at the internal rate of return, meaning it's product designed for cash accumulation. The drawback is if it's a limited pay product, I'm only going to pay into it for 10 or 15 years. So usually seeing both upfront helps people a lot. This is exactly what I like to do for folks, is just show them the different options, typically starting with the option where the parent can fund it forever, they can stop early and then give it to the child, make it flexible, and then compare that with a limited pay product. So here is a high early cash value product, which actually looks a lot better long-term than MassMutual's Whole Life 100 when you compare them now. That wasn't the case 3 or 4 years ago, but since the industry change, that is the case where it does look better long-term as well. But anyway, here we've got 10K per year, and there's our minimum premium, so $1,000 base premium. We've got a term rider attached, and we're plowing everything else into PUAs. This is on a 5-year-old, and this is an example actually where we just pay into it until he's 65. And you could go longer than that. So we funded it literally 10K per year for 60 years. He started at 5, so he'd be 65. So that's 600 grand that was paid in. If you look at the cash value, almost 3.7 million, based on the current dividend that is going to change. But this shows a product for a 5-year-old with the option to continue to add money as long as they'd like, which is nice. Some parents like to do this, especially those that want the policy to continuously be fed to leave a large legacy to the next generation. And if health issues occur, which can absolutely happen to anyone, that's nice where I can lock in the health rating for a 5-year-old when someone's very, very healthy. But let's look at this exact same product with stopping funding after 15 years. Check this out. So we're going to look at this on Excel in a moment, but if you rewind a little bit, you'll notice through the 15th year, everything's identical about this option because it's the same policy. The only difference we did is stop the funding altogether after the 15th year. And it's set up in a manner where that $1,000 premium, it's due here, but they're not paying it. It's being paid through dividends and interest. If they want to resume paying that, they can. But that's stopping after 15 years. Okay, let's take a look at this on Excel. Here's the first one, funding until they're 65. So for a long time, which is cool. Then we're going to look at the same exact product. So this is that high early cash value or life pay. We can pay into it until we're 85 years old. But funding for 15 years, and then paying just the minimal. So I didn't show this illustration. I can pull it back up. I promise it's on that from the PDF illustration though. It always is. So there you go. After the 15th year, we assume that the child, junior, keeps funding $1,000 per year, just the minimum premium, which will continue to build the cash value. This is why a lot of parents will go with this type of option for a child. And then the same thing with funding stopping altogether after 15 years. All right, cool. We got that. Let's look at the limited pay product though, because this is where people just look at it and say, wait a minute, I think I'm going to do this. So here's a 15 pay product, meaning 15 pay is 15 years, which is how long I can pay the premium for. So here we go. Premium with this is forced a little bit higher, about $2,000 instead of $1,000. But after the 15th year, there's no more premium due. Can't pay a premium anymore because it's not due. It's paid up after 15 years when junior is 20. So mom and dad can still give him the policy at this point in time. He just can't add money. He can borrow and repay and all that good stuff, but I can't feed the beast anymore. Quick side note is if you're going to give a child a policy, just be aware that any gains on the policy are taxable to the new owner as ordinary income. So if that's something you want to avoid, maybe we look at transferring ownership before that, or we look to position it in a trust. There are things you can do. We've got another video that goes into the detail on that. But that's always good to be aware of because we've got a gain by year 5 in this particular example. That's when we break even. But back to the purpose of this video. This is a pure 15 pay product. And then we also have a pure 10 pay product, which just means the premium is due for 10 years. So here's what helps people really refine their decision-making process. Let's compare the high early cash value product funded for 15 years. This is the same option that allows you to pay into it as long as you'd like, up until 85 years old. So we've got the annual ROR, which is the annual yield. That's your net yearly growth rate. Then we have the 15 pay product. Upfront, it is less. What do you notice, however? By year 15, or call it year 16, you're close to 5.4, and eventually you see it hit just about 5.5%. Whereas over here, a little bit lower. Still attractive, but see the difference? We're going to look at this in terms of dollars in a moment. Here's the 10 pay product. Even stronger. This product is designed for cash accumulation. Now, if you say those percentages look small when you compare them, look at when he is 30 years old. With the life pay option, where he stopped in 15 years, he's got $330 in cash value. With the 15 pay product, he's got $350. The 10 pay, this is not really a fair comparison because we only pay in for 10 years, but you're at 265. But the first two, there's a $20,000 difference there, and we paid a total of $150. If you scroll down, that difference is going to amplify over time. Look at this. By the time he is 60, option 1, 1.57, option 2, 1.738. Same company and same product. I'm sorry, same company, different product. See the difference there? Let's compare the first two we did, but looking at the cash value difference. This might be a little bit easier. On the left is that life pay, $10K per year for 15 years. On the right is the 15 pay. Then you have your cash value difference, which will simply show you how much more or less you have in cash value with the 15 pay product compared to the life pay product or the higher early cash value. All right. What happens as time passes? The difference amplifies. Ready to see something cool? Let's go back to this option. So you've got 10K per year for 15 years. This is the life pay at high early cash value. 10K per year, assuming mom and dad fund it until junior's 20. Then junior takes over, says, I can't fund 10K per year, but I like how this is growing. Like if I put 1,000 in, I see it go from 200 to 210, almost 211. Yes, I'm incentivized to keep on adding, which provides motivation to keep on saving. A lot of parents like to instill that in their children. So I have that benefit there, which is really nice. But check this out. Here's your 15 pay. Here's your cash value difference. Which one do you have more in? The 15 pay. What's the big difference? Let's go down to when he's 40 years old, which is near the bottom. 40 years old. 548. 598. A $14,000 difference in favor of the 15 pay. But there's something else that you might have caught on to. We paid more money into the option on the left, but the option on the right still has another $14,000, which means in reality, we add the $20,000 that we paid into the option on the left, the difference is closer to $34,000. And that's assuming just a 0% return added to the option on the right. See where I'm going with this? So on the right, you've got a pure limited pay product, which is designed for greater long-term cash accumulation. So it's nice to see these options. Often when we speak with clients and we're looking at options for their children, we like to go over both and really see which one they prefer. And something I always like to say, if someone's torn, maybe they want to instill habits in their children, so they want to give them a policy where they can keep on adding, but they like how these perform, is split it. This shows 10K per year. It could be one of each with 5K per year. You could do one of each where you have $2,000 or $3,000 per year, or just one that you like the most with $2,000 or $3,000 per year. You can set them up where they're very low amounts because for children, the cost of insurance is minimum. It's very easy to push that base premium low. But this is always beneficial to look at because a lot of times we just think, I used to think option one would make the most sense, where I just give the policy to the kid afterwards and then they can keep on adding. However, if I'm really attracted to a product that is going to give them the most money and I'm not sure that I want them to keep adding, I could be a parent that just says, no, if they want to keep adding, when they learn about it, they can get a new policy at that point in time. This option really cooks, and if I, the parent, want to use it as well over the years while they are still a minor, well, the parents own it, so they can do that. So I like both. Personally, I like option two a little bit more with the option to stop altogether and see that cash value cook, but everyone's different. So I do hope that you enjoyed this video. I'd love to hear any questions, comments, thoughts. Feel free to leave them below. And as always, I hope this helps. Thanks so much.